We do see a lot of negativity being discussed that might scare consumers and have them pull their horns in. But broadly speaking, the job market still looks pretty good to us. Unemployment looks good, wages look good, overall wealth for consumers looks pretty good. They seem to still be purchasing. The industrial economy still looks pretty healthy. I'd say the place that we have the biggest question mark is in trade and making sure we navigate this dispute with China and then not pick other disputes that disrupt the marketplace.
On that topic, let's talk about agricultural shipments. We saw a decline in volume last year in agriculture. In fact, pricing was up a little bit. Where do things stand on that front? And is a US-China trade deal the key swing factor for the year ahead?
Yeah, in our agricultural products business, both last year, certainly in the second half, and now early in this part of this year, we see an impact by the China dispute. They're not buying soybeans so much from the U.S. as they had historically, and they were a significant buyer of beans from the U.S. And that's disrupted our marketplace on the grain side of agricultural products. That looks like that's going to continue until that dispute remedies. We're finding other outlets for some of those products, but not to the same order of magnitude.
And is it game-changing? If you think about the numbers being talked about on the trade deal, is it game-changing in terms of volumes for U.S. agricultural that you'd be moving, or is it just going back to the norm where it was before?
I think it would go back to the norm, and what I would hope is it would go back to the norm entirely. You know, once the supply chain's been disrupted, a lot of times that supply chain doesn't recover entirely because the buyers get used to their new source, or they adjust their overall supply chain logistics around it, and they're a little bit hesitant to go all the way back. So, you know, I'd be a little concerned that now that it's been disrupted, whether or not it comes back completely.
Moving on to energy shipments, kind of similar story to last year. You see volumes down, but pricing up. How are you feeling about that in the year ahead?
Yeah, energy shipments for us are largely about coal and also frac sand. And both are in negative territory right now. Coal year-to-date's off by about a handful of percentage points. Frac sand a bit more. Coal's all about a kind of a long-term secular decline, and then in any given little period, it's about what's happening in the weather and what's happening in specific burn. Frac sand is seeing in-basin sources replace the sources that we bring down from Wisconsin and Minnesota into places like the Permian. Now we're participating in some of those in-basin sources, but it's a much shorter haul and it's less business.
Some job cuts, 250 last month and furloughing 450 as well. Temporary workers, it followed some more cuts from last year.
Yes.
Is that it now, or are there more to come in the year ahead?
Well, those numbers that you were referring to were reductions in our managerial and administrative, if you will, the supporting staff for executing the business plan. I think we're approaching about where we want to be in that context. It's been hard work. It's not enjoyable work. It's always difficult to adjust your administration to size what it really needs to be in the long run. It has some corollary benefits. It's making us quicker in decision making, and it's removed some levels of bureaucracy so that we're able to drive decisions down to where the work's actually occurring. That's all an important part of this change.
And just finally, I wanted to talk about your capital return program. Last year, around $13 billion in total return, whether it was dividends or buybacks. Given the political environment at the moment, do you worry that you get a backlash for putting those sort of programs in place?
Well, if I worry that the general public doesn't understand what happens to cash when it's generated by a large corporation like us. So if you think about all the cash we generate from revenue, the first thing we do with it is pay wages, we buy stuff, we make sure we got the right capital structure in place, we make sure we're investing in the railroad. That's the vast majority of the use of our cash. After that, our shareholders like dividends, so we make sure we pay dividends. After that, when there's cash left over, we buy shares, because our shareholders also like the tax-efficient method of returning dollars to them. We do all of that, and we'll continue to do all of that.